Ladies and gentlemen, the Vice President and I are very pleased to welcome you to our press conference. We will now report on the outcome of today's meeting of the Governing Council, which was also attended by Commission Vice President Mr. Rehn. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged. Incoming information confirms that the moderate recovery of the euro area economy is proceeding in line with our previous assessment. At the same time, recent information remains consistent with our expectation of a prolonged period of low inflation, followed by a gradual upward movement in HICP inflation rates. The signals from the monetary analysis confirm the picture of subdued underlying price pressures in the euro area over the medium term. Inflation expectations for the euro area over the medium to long term continue to be firmly anchored, in line with our aim of maintaining inflation rates below but close to 2%. Looking ahead, we will monitor developments very closely, and we will consider all instruments available to us. We are resolute in our determination to maintain a high degree of monetary accommodation and act swiftly if required. Hence, we do not exclude further monetary policy easing, and we firmly reiterate that we continue to expect the ECB interest rates to remain at present or lower levels for an extended period of time. This expectation is based on the overall subdued outlook for inflation, extending into the medium term, given the broad-based weakness of the economy, the high degree of unutilized capacity, and the subdued money and credit creation. At the same time, we are closely following developments on the money markets. The Governing Council is unanimous in its commitment to using also unconventional instruments within its mandate in order to cope effectively with risks of a too prolonged period of low inflation. Let me now explain our assessment in greater detail, starting with the economic analysis. Real GDP in the euro area rose by 0.2% quarter on quarter in the last quarter of 2013, after 0.1% and 0.3% in the previous two quarters, respectively. Survey data that encompass the first quarter of this year are consistent with continued moderate growth, confirming previous expectations that the ongoing recovery is increasingly supported by firmer domestic demand. Looking ahead, some further improvement in domestic demand should materialize, supported by the accommodative monetary policy stance, ongoing improvements in financing conditions working their way through to the real economy, and the progress made in fiscal consolidation and structural reforms. In addition, real incomes are supported by moderate price developments, in particular lower energy prices. Economic activity is also expected to benefit from a gradual strengthening of demand for euro area exports. At the same time, although labor markets have shown the first signs of improvement, unemployment in the euro area remains high, and overall, unutilized capacity is sizable. Moreover, the necessary balance sheet adjustments in the public and the private sector will continue to weigh on the pace of economic recovery. The risks surrounding the economic outlook for the euro area continue to be on the downside. Developments in global financial markets and in emerging market economies, as well as geopolitical risks, may have the potential to affect economic conditions negatively. Other downside risks include weaker than expected domestic demand and insufficient implementation of structural reforms in euro area countries, as well as weaker export growth. According to Eurostat's flash estimate, euro area annual HICP inflation was 0.5% in March 2014, down from 0.7% in February. The decrease reflects falls in the annual rates of change of the food, goods, and services components, partly offset by a more moderate decline in energy prices. On the basis of current exchange rates and prevailing futures prices for energy, annual HICP inflation is expected to pick up somewhat in April, partly related to the volatility of service prices in the months around Easter. Over the following months, annual HICP inflation is expected to remain low before gradually increasing during 2015 to reach levels closer to 2% towards the end of 2016. At the same time, medium to long-term inflation expectations remain firmly anchored in line with price stability. The Governing Council sees both upside and downside risks to the outlook for price developments as limited and broadly balanced over the medium term. In this context, the possible repercussions of both geopolitical risks and exchange rate developments will be monitored closely. Turning to the monetary analysis, data for February 2014 point to subdued underlying growth in broad money. Annual growth in M3 was broadly stable in February at 1.3%, compared with 1.2% in January. The growth of the narrow monetary aggregate, M1, remained robust at 6.2% in February after 6.1% in January. The main factors supporting annual M3 growth continued to be the increase in the MFI net external asset position, reflecting the keen interest of international investors in euro area assets. MFI loans to the private sector continued to decline in February. The annual rate of change of loans to the non-financial corporations was minus 3.1%, compared with minus 2.8% in January. Weak loan dynamics for non-financial corporations continue to reflect their lagged relationship with the business cycle, credit risk, and the ongoing adjustment of financial and non-financial sector balance sheets. The annual growth rate of loans to households stood at 0.4% in February 2014, still broadly unchanged since the beginning of 2013. Since the summer of 2012, substantial progress has been made in improving the funding situation of banks. In order to ensure an adequate transmission of monetary policy to the financing conditions in euro area countries, it is essential that the fragmentation of euro area credit markets declines further, and that the resilience of banks is strengthened where needed. This is the objective of the ongoing comprehensive assessment by the ECB. To sum up, The economic analysis confirms our expectation of a prolonged period of low inflation, followed by a gradual upward movement in HICP inflation rates towards levels closer to 2%. A cross-check with the signals from the monetary analysis confirms the picture of subdued underlying price pressures in the euro area over the medium term. As regards fiscal policies, euro area countries have made important progress in correcting fiscal imbalances. They should not unravel past consolidation efforts, achievements, and should put high government debt ratios on a downward trajectory over the medium term, in line with the Stability and Growth Pact. Fiscal strategies should ensure a growth-friendly composition of consolidation to achieve better quality and more efficient public services, while minimizing the distortionary effects of taxation. Further, decisive steps are needed to reform product and labor markets with a view to improving competitiveness, raising potential growth, generating employment opportunities, and making euro area economies more flexible. We are now at your disposal for questions.
Claire Jones, Financial Times.
Claire Jones, Financial Times. Mr. Draghi, in your comments there, you noted that the Governing Council was unanimous in its commitment to using unconventional instruments that are within its mandate. Can you tell us whether or not that includes QE with a government bond element to it? And for my second question, are the Governing Council unanimous in what sort of conditions they'd need to see result in terms of the outlook and also in terms of the exchange rate in order to tap some of these unconventional measures?
I think you rightly pointed out a key sentence in the statement. The Governing Council is unanimous in its commitment to using also unconventional measures, meaning that we haven't finished with our conventional measures. Also unconventional instruments within its mandate in order to cope effectively with risks of a too prolonged period of low inflation. So this statement says that all instruments that fall within the mandate, including QE, are intended to be part of this statement. There was, in fact, during the discussion we had today, there was a discussion of QE. It was not neglected in the course of what was actually a very rich and ample discussion. The other question is, first of all, let me restate, the exchange rate is very important for price stability, so much so that we've made an explicit reference in the introductory statement, as you've seen, where we say that the Governing Council sees both upside and downside risks to the outlook for price developments as limited and broadly balanced over the medium term. In this context, the possible repercussions of both geopolitical risks and exchange rate developments will be monitored closely. But it's, as I said several times, it's not a policy target. It's an increasingly important factor in our medium-term assessment of price stability, but it's not a policy target. In this sense, we don't link our medium-term assessment with a precise level of the exchange rate. It's part of the overall information that comes into play when we do our medium-term assessment. Thank you.
Stefan Riecher, Bloomberg.
Good afternoon, Mr. Draghi. First question relating to the inflation rate, but not so much referring to consumer prices, but to producer prices, where we've seen 2 consecutive months of a decline. So if you take producer prices, you could argue actually already in a deflationary scenario. To what extent would you consider producer prices and how important are they for your assessment? Second question, quite simply, was today's decision to not change interest rates unanimous or not? Thank you.
Thank you. Certainly, the producer prices have shown an even weaker dynamics than other prices, and especially HICP or even core inflation. In spite of that, we don't see the risk to deflation as having increased with respect to our assessment, which basically says that these risks are limited on both sides. The discussion was actually very, as I said, was very rich, and the main difference of viewpoints was in the following point: to what extent the latest data on inflation does change the medium-term outlook. In this sense, the situation today was different from November, where we had certainty, and in fact it turned out to be exactly so. We had certainty that the data that had come out in November, lower than expected, would change the medium-term outlook. This time it came out lower than expected, and if you're interested, I can explain you why some of it was expected, but some of it was not expected, so it came out lower than expected. And then the difference of views was whether it actually is changing the medium-term outlook or not. In the end, it was thought that we need more information to assess whether there has been a change in the medium-term outlook. The final, I would say, you obviously have different viewpoints, but the final consensus around which the Governing Council came was exactly this, was the one that is being illustrated in the introductory statement. In the course of this discussion, however, let me say, we talked about lower interest rates, we talked about lower deposit facility rate, we talked about prolonging the fixed rate full allotment, we talked about QE. So there was an ample, and as I said before, rich discussion, which is confirmed by the statement that I already read about the unanimity of the Governing Council in its commitment to fight risks for price stability.
Brian Blackstone, Wall Street Journal.
Brian Blackstone with the Wall Street Journal. Can you just describe a little bit more what kind of information you're looking for on whether or not these latest inflation figures are changing your medium-term outlook? If you're not going to act when it's 0.5, what does it take to get you to act on some of these things? And my second question is, you've clearly changed the rhetoric a little bit in terms of your willingness to act swiftly, being resolute. But does your rhetoric and your easing bias lose its credibility each passing month that you do nothing in the face of these very low inflation rates? Thank you.
Yes. On the first point, there are a couple of factors that somehow clouded the analysis, made it more difficult, the analysis of whether this latest inflation data would actually be a material change in our medium-term outlook or not. One has to do with the volatility of services prices and the fact that Easter time this year comes remarkably later than last year. The explanation is that around Easter time, services expenditure usually goes up, demand for services goes up, especially travels. And this has affected last year prices, and it's going to affect this year prices. So you have a base effect which produced a very sort of a much lower inflation data for in March, and may well produce a higher inflation data next month. The second point was simply a base effect of energy prices. So these two factors somehow made the analysis, which is relevant for our decision making, more complex. So we will see in the coming months, or even we need some more observational points, and we will have our assessment in the course of time. Now, I'm not sure we're actually losing credibility on our forward guidance. As a matter of fact, if you look at the interest rates, short-term interest rates, and the forward yield curves, our forward guidance has been and is being quite successful. The medium-term forward interest rates have been fairly well anchored and stable to the levels that we wanted, even though the period over the last 3, 4, 5 months has seen substantial, I wouldn't say volatility, but certainly numerous actions by other jurisdictions, both on the monetary policy front, but also if you consider the volatility that has characterized emerging market economies, exchange rates and interest rates. So, notwithstanding these external developments, the forward curves, the medium-term forward curves and the short-term money market curves remain pretty stable. So, if you judge success of a forward guidance by this measure, you would tend, perhaps I'm a biased observer, of course, but I think the Governing Council would agree with this and would define the forward guidance as having been quite successful.
Markus Südra.
Markus Südra, Süddeutsche Zeitung. 2 questions. The first one is, you stressed the great unity on the Council regarding...
I'm sorry,
You stressed the great unity. You agreed on that QE is a measure to be taken, and you said nobody basically opposed against it. Does that mean that last month, for example, there has not been any unity on the topic, so there was a dispute about QE? And the second question, could you elaborate on QE, on the discussion today, and tell us why you discussed it today? So what was the reason?
Well, no, it's different from what you said. Last month we didn't discuss QE explicitly, and this explains why we discussed it this month. It's quite obvious that the Governing Council is looking at this prolonged period of low inflation. And it's quite obvious that the longer is, as I said, I think I did say this several times, the longer is the period of low inflation, the higher is the risk for inflation expectations in the medium and the long term. That's why we discussed, and that's the reason for this statement here. But let me also add one other consideration that applies also to the question that was asked me before by Brian a moment ago. If you take the rate of inflation of the first quarter of 2012 was 2.7%. Now it's 0.5. Of these 2.2 percentage points of difference, 70% of this is due to lower energy prices and lower food prices. So when we consider this, you are in a situation where at the same time one is concerned because this is a low inflation which has some drawbacks, also some positive things in the sense that supports the real disposable income, especially of those people who have a fixed nominal income. And at the same time, this is being caused by exogenous factors. In fact, if you see what is the inflation rate in other countries, take the United States, where they are way more advanced in their recovery than we are. Take Sweden. You see that the low inflation contains a high percentage of global factors.
Jack Ewing.
Jack Ewing, New York Times. 2 questions. One is, I wonder if you could just elaborate on what are the risks of low inflation, not deflation, but low inflation, for example, on debtors in the Eurozone, and how big a risk is that in the view of the Governing Council? And the second question is, if you did decide to do QE, maybe you could tell us a little bit about how that would be designed in the context of the Eurozone, given the structure of the bond market and so forth. Thank you very much.
Thank you. On the second question is something that we will be reflecting hard and thinking hard. It is a question about how to design the QE, considering that our institutional and financial setup is considerably different from what it is in the United States, for example. In the United States, the effect of a kind of a QE is immediate on all the asset prices, and the effect on the term premium is also quite direct. Because it's an economy based on capital markets. In our case, it's an economy based on the bank lending channel, and therefore the effect has to be carefully, the program has to be carefully designed in order to take this element into account. This is on the other point, the period of low inflation, a long period of low inflation, first and foremost, as I said before, the longer is the period of low inflation, the higher is the risk for the medium-term inflation expectations, which at the present time are firmly anchored, and also in our view of the medium term, they represent the anchor towards which inflation will gradually pick up and will converge in the medium term. The second drawback of a low inflation, especially in an area like the euro area, is that it makes the adjustment of imbalances much more difficult. One thing is to have to adjust relative prices with an inflation rate which is around 2%. Another thing is to adjust relative prices with an inflation rate which is around 0.5%. That means that certain prices, in order to readjust this, will have to become negative. In other words, their change will have to become negative. And you know that prices and wages have a certain nominal rigidity, which makes these adjustments more complex. The third point, the third drawback, has to do with debt, with the presence of a debt level, which is both for private and public sectors, still high, elevated. And with low inflation, the real value of this debt doesn't go down as fast as it would if inflation were higher. So it makes the adjustment, the deleveraging, the adjustment of the debtors more difficult. Also, there's also a precautionary consideration here. You want to have an inflation rate which is as I said, close to 2, but below 2%, because you may have, and this is exactly what happened in Japan, you may actually have, you may think you have a non-zero inflation rate, positive inflation rate, while as a matter of fact, you are already in a deflationary situation. So for measurement reasons, also, one would have to prefer an inflation rate which is close but below 2%. As I said, we don't see these risks now in Europe. In the euro area, I've said several times that I've listed several times the differences between our situation and the situation in Japan in the 90s and the early 2000s, which, however, doesn't mean that the Governing Council should remain unconcerned. So that's the reason, and I here add something to the previous question, that's the reason for having such a wide and rich discussion today.
Jonathan Gould?
Jonathan Gould from Reuters. Two questions, Mr. Draghi. First of all, what is your biggest fear for the Eurozone economy at the moment? And secondly, you mentioned the discussion of a lower deposit rate a little while ago. Do you think that a negative deposit rate would be an appropriate way to tackle any further euro appreciation? And would it be preferable to cut the main refinancing rate at the same time as the deposit rate in that case?
Well, on the first question, my biggest fear is actually, to some extent, a reality, and that is the protracted stagnation longer than we have in our baseline scenario. And even so, right now, it's pretty severe, with levels of unemployment that are even though they have stabilized and we see marginal improvements here and there, they are very high. And the longer they persist, the more likely is that they will become structural, namely much harder to lower, or to lower through conventional policy measures. So that's my biggest fear. And so that's why monetary policy is important, but it's not the only thing. To respond to this fear, one needs a complex package of policies, and as we always stress, structural reforms come first. Because many of the problems of the euro area are structural. And I'm sure that is also the biggest fear for the Governing Council as a whole. We discussed certainly we discussed the possibility of negative deposit rate, but again, our objective is maintaining price stability. We don't discuss monetary policy measures for the effect they might have on the exchange rate. That is going to be determined by the marketplace. This is one of the elements that we consider for price stability. And it certainly was an instrument which received a good deal of attention during today's discussion. A lowering of the corridor was also another point of today's discussion.
Jean-Philippe Lacour, Les Échos.
Here am I. Two questions, Mr. Draghi. Explain me, please, why you don't insist on the core inflation in your communication. The core inflation, which is not polluted by one-off effects like Easter or other things, and that was down from 1 to 0.8 in March. So do the ECB pay much or should pay much attention to this core inflation rate, because it is in line with your forecasted inflation you communicated. So I make a short parallel with companies. They always in their financial communication insist on adjusted EBIT, for instance, adjusted earnings. So why the core inflation does not play this role in your communication? And secondly, is your second biggest fear maybe France? After you were in Paris last week and had very polite words, but the new French minister, finance minister, made today this first remarkable statement. He says something like France needs more time to deficit reduction, and we want to discuss this with the European Commission, so maybe because we need more delay to meet the 3% deficit threshold. So my question is, from the ECB point of view, how do you commend this statement, which recalls a bit ancient times when France and Germany together torpedoed the Stability and Growth Pact? Thank you.
Thank you. Well, on the first question, it actually goes back to the beginning of this institution, when there was a long, prolonged discussion on whether it should be core inflation or headline inflation. This was, in US, core inflation was already a concept that was being used. And the Governing Council at that time decided that the important concept is headline inflation, because that would in a sense, there was, I remember someone who said, if you start using core inflation too much, you would exclude everything that moves around. And I think that was one of the reasons that inspired this choice at that time. Also, there are reasons that have to do with better capturing the pass-through effects of exogenous factors like, as I said, price of energy. But certainly what you said is absolutely correct. The core inflation this month declined less than the headline inflation at 0.8. It did decline from 1% to 0.8%. So it is above the headline inflation, showing the effects of energy and price. By the way, before I mentioned that There were two reasons for this effect in March for the 0.5. One was the volatility of services prices around Easter time, and the second one was a base effect on energy. But I should also add that this doesn't explain the whole of the difference. So to some other extent, the 0.5% in March came as a genuine surprise. We are not talking about huge differences, but the reasons that I've given you before explain the greatest part, but not 100% of the difference with the previous month. And our mandate, by the way, is expressed in terms, now this is a more legal reason, our mandate is expressed in terms of price stability, defined as headline inflation. There is no qualifier to this. But as you've seen, I mean, the more energy prices, the more food prices, the more outside factors, more generally commodity prices or taxes, indirect taxes, change the headline inflation, the more we had been using both concepts in our communication. The other point the other point you made is actually very, very important. From the ECB viewpoint, we've said, by the way, I've said in the introductory statement, let me reread it. As regards fiscal policies, euro area countries have made important progress in correcting fiscal imbalances. They should not unravel past consolidation achievements and should put high government debt ratios on a downward trajectory over the medium term in line with the Stability and Growth Pact. Now, this is important because we all remember the experience of to which you made reference of the early 2000s, and undermining agreed rules undermines trust. So it's quite important that fiscal consolidation be friendly, as I've said, be growth friendly, as I said many times, namely based on lower taxes, lower current government expenditure, perhaps if there is room, higher expenditure in infrastructure and structural reforms. So it's important that fiscal consolidation be having even a medium-term perspective, be growth-friendly, but it should adhere to the pre-agreed rules. Otherwise, trust is undermined. Thank you.
Mark Schraas, Börsenzeitung.
Mark Schraas, Börsenzeitung. Thank you. The first one is on the inflation figures from March. You said that service prices, energy prices are not enough to explain the decrease. And that there was also a downward surprise for you. Some people say that such downward surprises are becoming more the rule than the exception, looking at the October figures last year, the March figures this time. How worried are you about this fact, and what are the implications for the ECB? And the second question is on QE. Is it correct to understand your comments today the way that QE would not only be considered if there is a real threat for deflation in the euro area as a whole, but also if there is a risk of a too prolonged period of low inflation? Thank you.
Well, on the second question, I can only reread the statement that's been agreed by the whole Governing Council. The Governing Council is unanimous in its commitment to using also unconventional instruments within its mandate in order to cope effectively with risks of a too prolonged period of low inflation. So you are correct in your understanding of this sentence. The other point you made is also correct. The ECB's projections have been underestimating inflation a few times. And the reason for this is that, I should say, this has been quite common to most institutions. The reason for this is that they have underestimated the energy prices, the energy prices declines, or the lower rates of changes in energy prices. There is no doubt that some profound changes in the world energy markets are taking place. And you know which ones we may think about, but I mean it's a constant change on top of this. Also, one may want to consider, and I think I made reference to this in the introductory statement, the geopolitical risks that may materialize into changes in the energy prices as well. So you're right. It's been underestimated several times, and this had an immediate impact in underestimating a decline in the rate of change of prices.
Annette Weisbach.
Mr. President. Yeah, okay, Mr. President, Annette Weisbach from CNBC. Did I understand you right that you were saying that with the European setup of the economy being so dependent on banks, that a potential QE here in the Eurozone wouldn't work that efficiently like in the United States? And secondly, what's your answer to the managing director of the IMF, Christine Lagarde's calls to further ease monetary policy here in the Eurozone? Thank you very much.
You're welcome. You're welcome. On the first question, this has to be taken into account. When the Fed buys assets or buys government bonds, it does change prices all across the spectrum of all assets, and this has an immediate or direct effect on credit, because most of the credit goes to the real economy via the capital markets. See, that's the big difference. In our case, all this effect goes through the banks. So the final effect on the real economy depends, of course, on the demand for loans, but also on the state of health of the banking system. If the euro area can't really go back to growth, serious growth, if the banking system is impaired. A healthy banking system is more essential to the euro area than to other financial systems that are more market-based. In this sense, the asset quality review and the comprehensive assessment more broadly that the ECB is undertaking are crucial to restore trust in the banking system, to open capital markets for the banking system, as most importantly shed light on what is in the balance sheets of the banks of the euro area. And let me say that the developments that we've seen in the last 6-8 months are quite encouraging, because you have several large institutions all over the euro area now that are either recapitalizing themselves or selling assets or making huge provisions. So there is the sense that even without waiting for the end of the asset quality review, the simple fact that we are going to have this asset quality review has provoked a series of actions by the banks and by the supervisors to strengthen the banking system. So I'm pretty confident that by the time we will do the asset quality review, we'll actually find a stronger banking system than we had before announcing it. On the second point, I think the IMF the IMF has been of recent extremely generous in its suggestions on what we should do or not do, and we're really thankful for that. The viewpoints of the Governing Council are, in a sense, different, and I would like the IMF to be as generous as they have been towards us. Also with other monetary policy jurisdictions, like, for example, issuing statements just the day before an FOMC meeting would take place. Anyway, I think we will certainly value the advice of the IMF, and certainly is an important contribution to our analysis. Thank you.
Martin Bakkedax.
Martin Bakkedax from MNI. Mr. Draghi, you made two interesting adjectives in your opening statement, which I'm hoping you can maybe give us some guidance on. One, of course, is the too prolonged period of inflation, and I'm wondering if you might be able to elaborate on that, given your statements about the concern that is most pressing for you at the moment being stagnation. And the second was with respect to sizable unutilized capacity. And given that that's a relatively new component of your discussion, I'm wondering if it might be helpful for you to describe that in more specific terms and maybe going forward give deeper definition to the market as to how that will impact your conversations in the coming months.
Thank you. On the first point, the too prolonged period of low inflation is by itself, I think I said this, is by itself a risk. Because the longer is the period of low inflation, the more likely is the danger for inflation expectations in the medium term to be unanchored. So this is both a definition related to the length of time, to the time horizon, but it's also a definition that impinges on the risks of a lower inflation path than we have in our baseline scenario. It has these two dimensions, both time and risks. The second point you made is absolutely correct. This is the new concept that we've introduced last time in our introductory statement, but this time is even more explicit than it was last time. And this reflects the fact that even though we are witnessing improvements, and quite, must say, quite continuous improvements on the real side of the economy, PMI, both in hard data and survey data, we have evidence that there is plenty of slack in the euro area economy. Now, the issue is, of course, and you're aware of that, how do you measure it? How do we measure it? There are many definitions of this, but all of them are uncertain. However, whether we look at the labor markets, where we see a higher, much higher than historical average unemployment rates, or we look at the various definitions of output gap given by the IMF, the Commission, OECD, and each one of them uses different measures. So we see an output gap that is pretty wide and that only gradually closes up towards the end of our medium-term horizon. So that is that's the reason why we have to have a growth rate in the coming months higher than the potential, so as to close this basically this output gap, which weighs on demand and therefore on price stability. It's this is something I've discussed several times when we say that our low inflation rates do depend on global factors. They do depend on supply factors, relative price adjustments, but they also depend on the weakness of demand, where the existence of a wide output gap certainly plays a role. Though we got to be cautious about to measure this. Thank you.
Alessandro Merli.
Alessandro Merli of Il Sole 24 Ore. Could you clarify the issue of expectation, or inflationary expectation, which you say are firmly anchored? Actually, a number of measures of expectation show them sliding, and the convergence to the 2% moving further ahead in the future. Could you please explain maybe what is the time horizon that you're looking at when you look at inflationary expectation, because they are actually sliding on a shorter term. The other question follows from one of your previous answers. It's about credit. Some time ago, you seemed to think that as the AQR was done on the figures for the fourth quarter of or the end of 2013, then banks will take that into account in the extension of credit to the real economy already in the course of this year. This is clearly not happening. Actually, credit is still contracting. Do you now expect this to happen? I mean, a sort of recovery of credit only when the whole comprehensive assessment is finished, or before, or do you plan to do anything about that before then?
No, on the second, let me respond immediately on the second question, because we try to understand better what is happening here. And what's happening is, this comes from direct evidence with several large institutions. What happens here is that new credit is actually expanding. Is expanding actually at relatively decent rates. But what we observe is not, unfortunately, from the figures we have so far at least, I hope I have better figures next time, but what we have been observing is not new credit, is the gross credit. Namely, you have the new credit and you have the redemptions of old credit, which is coming due. For example, one of these institutions we've asked, they said they foresee a 4.5% expansion in credit, in new credits this year, but redemptions for something like 3%. So in the end, what we will be observing in the best case is 1.5% from this institution. I'm not making numbers for the whole area. And this is what happens, basically, that there are still deleveraging that has to take place where, frankly, this deleveraging is not caused by the AQR, but it's simply caused by an assessment of the credit quality that is in place and the bank's decision to improve credit quality, basically deleveraging the credits that are not profitable. So I think that's what we are observing. Improvement in lending to new clients, but at the same time, redemptions of old loans weighing on the figures of credit. The other question had to do with expectations. Well, here there are different measures. So if you take short-term expectations, you are absolutely correct. They are sliding down. If we take medium to long-term expectations, 5 years on 5 years, they remain well anchored to 2%. And that's basically we're trying to take a definition of expectations which relates to our concept of medium-term assessment, which is the concept through which we judge inflation, through which we judge and we undertake our outlook, we make our outlook assessment.
Estelle Péard.
Hello, Mr. Draghi. You told us about a few non-standard measures. Are other ones like new LTRO or S&P sterilization? Are they still on the table?
We have discussed we have discussed really mostly S&P sterilization, but we've also discussed briefly, more briefly than other points that I've mentioned before, LTRO. So I'm saying this to basically to make the following point. These are many instruments. Each one of them will address a specific risk. And for example, an LTRO untargeted would address a liquidity risk. An LTRO targeted, if successful, will address the lending to the real economy. Now, the problem with these two measures is that the second will have to be carefully designed so as to make sure that this incentive is actually effective in stimulating new lending. The ECB has done, I think, what was, I would say, possible. I think we've reacted immediately to these situations through a variety of measures. We'll continue to do so when we design an effective measure. And on the other measure, an untargeted LTRO, frankly, what you are observing now on the excess liquidity front is that we moved from 800 billion a year and a half ago, maybe 2 years, well, a year and a half ago, to about 100 billion now. We are in the 100 billion. And by the way, you asked about the forward guidance being successful. That's another evidence that with such a reduction in the excess liquidity, our forward guidance is still maintaining the rates where they are. That's why several times I warned not to work, not to have in mind, not to utilize a stable relationship between the excess liquidity and the short-term interest rates. So that was one question you asked about different instruments and?
And it was the same question, but on S&P sterilization. It's
Oh yeah,
measure.
well, we discussed that. Yes, we discussed that too.
Is there a measure who has your preference?
It's not my preference; it's the Governing Council preference. So we will continue discussing. And the important thing is the Governing Council is unanimous on, as I've said, in its commitment to using also unconventional instruments. So also conventional, but also unconventional instruments within its mandate in order to cope effectively with risks of a too prolonged period of low inflation.
Thank you.
Thank you.
Sebastian Joost.
Sebastian Joost, Die Welt. I'd like to ask another question about the possible design of QE. There were members of the Governing Council stating that QE could be less problematic in the euro area if you did not buy public debt but rather private debt. Would you agree with that? And what do you generally think about focusing a purchase program on private debt, given the fact that it would be rather limited in size in that case?
Yes, certainly. The answer to the first question is yes. There are obviously different preferences about which QE would be more effective. And we will continue working on that in the coming weeks. And the second point on private debt is well, you know, it's not easy to design a program of QE on private debt that is large in size and it doesn't have risks for financial stability. If we, however, that's why the ECB is so squarely behind the need to develop an ABS market, because that's where the largest pool of private sector assets lies. It's basically banking loans. As I said before, we are a bank-based economy. So if we are able to have these loans being correctly priced and rated and traded like it would happen, like it was happening, like it used to happen in the ABS before the crisis, then we naturally have a very large pool of assets. And the ECB is squarely behind this in a variety of ways. First and foremost, in its action to revisit the regulation for ABS. In the high point of the crisis, the regulation for ABS did not distinguish between simple ABS, like the ones who had mortgages in it, or ones that had some SME loans, and highly structured ABSs, quite complex. The first ones were typically European. The second ones were typically generated in the US. The default rate of the first was something like between 1% and 2%. The default rate of the second ones was between 16 and 18%. I can't remember now exactly the figures. In spite of this difference, the regulation concerning capital charges was the same. And the same thing for liquidity and other regulatory issues. So that's why we certainly we have to revisit this, and we find right now ample agreement also in other monetary policy jurisdictions. As a matter of fact, the ECB will present a joint paper with the Bank of England on this point at the next IMF meetings.
Thank you very much. We'll wrap up today. We have the Generation Euro Student Award starting in a few minutes, and we will be back for that.